Why is the so-called fiat crisis hedge acting like it's asleep, while silver and gold are blowing the doors off the market? What you're watching is not a normal headline spike. It's the kind of price behavior that signals something structural is shifting underneath, and you need to see it clearly, without tribal bias, without slogans, just cause and effect. If you want the deeper layer of analysis as this unfolds, subscribe, then turn on notifications so you catch the next breakdown the moment it drops. Start with the raw prints. Silver just surged past 170 an ounce as its recent high, and it's now trading around 112 to 113. Gold punched through $5,000. Palladium, platinum, natural gas, physical hard assets across the board are moving almost vertically in a way that most traders have never had to navigate live. Yet Bitcoin, the so-called digital gold, the asset that was marketed as the perfect answer to a fiat crisis, is sitting at $88,000, basically flat, and at times even down while metals are going parabolic. Read that again, because this is the part crypto doesn't like to confront. Silver is up over 270% in recent months, 270. Gold hit $5,100 per ounce. And Bitcoin, the fixed supply digital asset that every maximalist said would explode when paper money started cracking, can't even sustain a clean rally. What does that tell you? This is exactly the environment Bitcoin was supposedly built for, and it's being outperformed hard by physical metals. If you don't understand why, you're going to miss one of the most important macro signals of this cycle. Now connect the dots carefully. Begin with scale. Silver market capitalization in this environment has now overtaken Bitcoin's total market cap. Say it slowly. A metal pulled from the earth, held in the hand, used as money for 5,000 years, has right now a larger total market value than the entire Bitcoin network during what's supposed to be Bitcoin's moment. That alone tells you where confidence is flowing. Gold is sitting at record highs around $5,000 to $5,100 per ounce. Premiums on physical silver bars and coins are jumping as dealers struggle to find supply. And Bitcoin? $88,000, while the market eats billions in short liquidations and leveraged longs get steamrolled. That isn't a small gap, that's a real decoupling, not a theory, an observable split. So the question isn't, is this bullish? The question is, why is the hedge not hedging? For years, the simplified story was, Bitcoin is digital gold. Finite supply, 21 million coins, can't be printed. A shield against fiat debasement, a store of value for the modern world. Central banks print, governments spend, currencies weaken, Bitcoin moons. That was the pitch, and millions believed it. But right now, during what looks like an actual dollar crisis, with commodities screaming higher, Bitcoin is acting like it's on the wrong team. So either the story was incomplete, or the market is teaching a lesson most people don't want to learn. Here's the lesson, broken down cleanly. We are not in a broad fiat collapse. We are in a targeted dollar crisis, and the difference matters. The US dollar is weakening significantly against the yen, the euro, the pound. The Federal Reserve has intervened in currency markets, that's documented, to try and stabilize the yen-dollar cross. The United States is staring at government shutdown threats, political chaos, and heavy debt refinancing pressure. Over 1/3 of U.S. debt needs to be rolled over this year alone. That's trillions of dollars that have to be refinanced and placed with buyers in a market that's already tense about dollar-denominated assets. And rolled over simply means replacing maturing debt with new debt. Old IOUs get swapped for fresh IOUs. So the system constantly needs willing buyers. Now link that to commodities. Most major commodities are priced in US dollars. When the dollar weakens, those dollar-priced commodities tend to rise. Gold, silver, oil, copper, natural gas. If the dollar falls, it takes fewer euros or yen to buy the same ounce of metal. That pulls foreign buyers in. At the same time, domestic buyers feel purchasing power slipping and rotate into hard assets. This is a mechanical relationship that's shown up in major currency crises, from Weimar Germany to modern Turkey to Zimbabwe, and it's showing up again now. But here's what breaks the maximalist framing. In this stress window, physical hard assets are getting the flight to safety bid. Digital assets are not. Assets are, and there's a reason for that. In real uncertainty, when investors aren't confident governments can pay bills, when they worry about stability, when liquidity feels scarce, people don't behave like internet narratives say they should. They raise cash, they reduce exposure, and they run toward what they personally define as safe. And right now, the market is treating Bitcoin like a liquid risk-on instrument, not like digital gold. Look at deleveraging. When leverage gets forced out of the system, margin reduced, positions cut, risk compressed, crypto often gets hit first because it's easy to sell. It trades 24/7, it's liquid, and in many institutional risk models, it's still categorized as speculative. When margin calls hit, when funds face redemptions, when uncertainty spikes and everyone wants liquidity, Bitcoin is one of the quickest assets to convert into cash. They don't sell it because they hate it. They sell it because it solves the immediate need, cash, right now. They don't need a thesis in that moment. They need liquidity. That's why you're seeing what you're seeing. Billions in realized losses on Bitcoin shorts and leveraged long liquidations, while metals keep grinding higher day after day. Gold and silver behave differently in this environment. They get hoarded, they get removed from the market, they get stored. Physical buyers aren't dumping into the rally, they're adding into it. You can see it in COMEX registered inventories that have been under pressure for months. You can see it in Shanghai Gold Exchange premiums that remain elevated. You can see it in retail coin and bar demand, where shelves clear quickly and dealers struggle to replenish. This doesn't read like froth. It reads like accumulation, people locking up tangible assets as trust starts to crack. And here's the reframing that ties the whole picture together. Bitcoin isn't struggling right now because it's bad technology, or because the 21 million supply cap suddenly stopped mattering. Bitcoin is struggling because it's abstract. You can't touch it, you can't hold it, you can't bury it in your backyard or lock it in a safe and know with absolute certainty it's there, regardless of what happens to the internet, the power grid, the banking system, or the regulatory environment. In a crisis of confidence, tangible beats digital for a lot of people, especially when fear turns practical and they start thinking about power, access, and rules. Now compare that to silver and gold. They're elements on the periodic table. They exist independent of any government, corporation, or network. They've been money longer than any empire has existed. When you hold an ounce of silver, you're holding something that had value in ancient Rome, in imperial China, in the California gold rush, and it will still have value 100 years from now. There's no counterparty risk. There's no code vulnerability. There's no regulatory switch that can erase it. It just is. Bitcoin has real strengths: portability, divisibility, censorship, resistance, but it does not deliver that same visceral tangibility. And in moments of real fear, not theoretical fear, not macro Twitter fear, but the fear you feel when you genuinely don't know if the system holds, people grab what they can touch. That's what the flows are saying. Capital is voting, and the vote right now is overwhelmingly physical. Now, even in chaos, the technical map still matters. Silver broke through a massive multi-year resistance zone around $32 to $35 months ago. That breakout triggered algorithmic buy programs, momentum funds, and technical buying that pushed price higher in waves. The push from $35 to $70 was fast. The leg from $70 to $110 was parabolic, and the spike above $117 recently looked like classic capitulation. Shorts covering, FOMO chasing, physical premiums spiking, and futures markets dislocating from spot. Gold's move has been steadier, but it's been just as relentless. The break above $2,700 per ounce was the key technical tell. From there, it's been a grind higher with periodic bursts through psychological levels, 3,000, 4,000, and now 5,000, while momentum indicators like RSI still aren't showing extreme overbought readings on the weekly charts. That matters, because it suggests this isn't only emotion. It looks like structural repricing of gold in a world where trust in fiat currencies is eroding faster than central banks can print. Bitcoin, by comparison, has looked weak on the chart in this window. The failure to break convincingly above $90,000 while metals were launching was the first warning. The subsequent rollover and inability to hold key support around $92,000 showed buyers weren't stepping in with the same conviction. Volume profiles look more like distribution than accumulation. Realized profit and loss data shows long liquidations outpacing short covering. That's not what you want from an asset that's supposed to be the macro hedge. But keep this balanced. The point is not Bitcoin is dead. The point is to interpret what's happening right now. And right now, Bitcoin is being traded like a risk asset, not a safe haven. That can change. Maybe it changes tomorrow. Maybe it changes when the dollar stabilizes, when equity markets find a bottom, or when regulatory clarity improves. But today, in this moment with these flows, physical metals are winning and Bitcoin is not. We also have to be honest about what could go wrong for metals. Industrial demand for silver, one pillar of the deficit story, could weaken if we slide into a global recession. China's economy is slowing. Europe is barely growing. U.S. manufacturing data has been mixed. If industrial offtake drops sharply, that removes a key support under silver's bullish thesis. Gold, although less tied to industry, can still face profit-taking at these levels. $5,000 per ounce is a psychological magnet for sellers. Miners are hedging. Central banks might slow purchases. Technically, both metals are extended and vulnerable to sharp pullbacks. And for Bitcoin, the bearish case remains straightforward. It still carries correlation to risk assets like the Nasdaq. If equities roll over hard, Bitcoin likely follows. Regulatory uncertainty persists, especially with new administrations and potential crackdowns on stablecoins or DeFi. The digital gold narrative only works if enough people believe it. And the tape right now suggests that belief is being stress tested. That's the risk. But here's the counterpoint that matters most. The dollar crisis isn't finished. It's accelerating. Debt refinancing needs are growing. Political dysfunction is getting worse. The Federal Reserve is trapped between inflation and recession, and every policy choice creates new dislocations. As long as the dollar remains weak, commodities priced in dollars will keep catching a tailwind. And this weakness is starting to look structural, not cyclical. This isn't a quick dip. This is a multi-year trend tied to unsustainable fiscal policy, trade imbalances, and the slow erosion of the dollar's reserve currency status. On top of that, physical metal supply remains constrained. Silver mine supply is not keeping pace with industrial demand growth from solar, EVs, AI data centers, 5G infrastructure, and defense applications. The deficit is real. Inventories are falling. Above-ground stockpiles are being drawn down. And unlike Bitcoin, you can't just increase production by switching on more computers. New mines take years. Exploration budgets were slashed after the last bear market. The supply response is lagging badly. Geopolitical fragmentation adds fuel. China has implemented export controls on critical minerals. The US is reshoring supply chains and imposing tariffs. BRICS nations are diversifying away from the dollar and buying gold. Central banks set a record for gold purchases in recent years, and that pattern is continuing. This is documented, verifiable behavior by sovereign entities managing trillions in reserves. They're buying physical metal, not Bitcoin. And here's the kicker. If Bitcoin eventually does catch up, if it starts acting like the digital gold it's supposed to be, metals likely run with it, and probably harder, because the driver would be the same: loss of confidence in fiat currency systems. The scenario where Bitcoin moons and metals collapse doesn't make sense. They're not inversely correlated. They're both alternatives to fiat. So this divergence is either temporary, Bitcoin catches up, or it's revealing something fundamental about what people trust when the system is under stress. Let that sink in. The crypto bell is ringing loud. The maximalists are yelling, "This is Bitcoin's moment," and the chart is not confirming it. Or more precisely, the buyers who are showing up are buying silver and gold instead. They're voting with capital for tangible over digital, for 5,000-year track records over 15-year experiments, for physical certainty over cryptographic abstractions. Does that mean Bitcoin has no place in a portfolio? No. Bitcoin has unique properties. It's portable across borders in ways gold will never be. It's divisible to 8 decimal places. It's resistant to confiscation if you manage your keys properly. For people living with hyperinflating currencies or under authoritarian governments, Bitcoin can be a lifeline. Those use cases are real. But as a macro hedge in a dollar crisis, the market is telling you right now that Bitcoin isn't behaving the way the narrative promised. So here are the 3 takeaways. 1. We are in a targeted dollar crisis, not a broad fiat collapse. That difference helps explain why commodities are rallying and Bitcoin isn't. 2. Physical hard assets are absorbing safe haven flows because tangibility matters more than most crypto advocates want to admit. 3. The divergence won't last forever, but until Bitcoin proves it can act as a store of value in real stress, it trades like a speculative asset, not digital gold. And the unresolved tension is this: if the dollar crisis deepens, if debt spirals out of control, if inflation roars back, or if deflation crushes growth, what breaks first? Does Bitcoin finally catch a bid as the ultimate non-sovereign asset, or do metals keep running while crypto bleeds? I don't have that answer. Nobody does. But the capital flows right now are clear, and ignoring them because they don't fit your thesis is a mistake. For physical metal holders, this is vindication. The thesis is playing out. For Bitcoin holders, this is a moment to reassess, not panic, not capitulate. Ask the hard questions about what you own and why. And for people sitting in cash or short-term treasuries watching this unfold, the reminder is simple. Doing nothing has a cost. Inflation eats you alive, even when nominal numbers look calm.